All right, so good morning, good afternoon, everyone, and welcome to another training session for Danuvie CryptoBot. My name is Daniel Uvietesiwi. I am your host, and I am the CEO and also the Chief Programming Officer at Danuvie CryptoBot. And in today's lesson, or before we get into that, we would like to give an apology. Today we could not hold the live session due to internet instability. So we decided that we're going to create a recording for today's lesson, and then we'll post in the Telegram group so that everybody can watch and benefit from it. Okay, so in today's lesson, we're going to be looking at 3 different topics, and the topics are as follows. The first topic is why you must know when the big banks and big players are trading. So there is a reason why you must know when these guys are trading. And after we finish this topic, there's a story I'm going to narrate for you, and it's going to tell you the reason why we must know when big players are trading and banks. Okay, and so the second topic is going to be market cap and liquidity. This is also a very important topic in trading of digital assets, cryptocurrencies, and all that. So we're going to be looking at what market cap is, what liquidity is, and how it will affect the authentic nature of a coin and how well you can trade that coin on your various cryptocurrency exchanges. So the second topic is market cap and liquidity. And then the final topic today is going to be basic entry process. So which means today we are going to be looking at the basic entry process, and then we're going to be looking at the live chart. So which means we're going to go into the live chart and we're going to show you the basic entry process. Whenever you receive a signal from the bot, we're going to look at the basic entry process before you place a trade. So let's dive right into the video. So we go to the first topic for today, which is why you must know when big players and banks are trading. Okay, so this is it. It says why you must know when the big players are trading. Now, in every market, whether it's crypto, forex, or stocks, price doesn't move by luck. So you can see that there is always a reason why the price moves. Price doesn't just move by itself. There must be something that has happened that will make price move. That's why he said price doesn't move by luck. Okay, let's continue. It moves because big banks, hedge funds, and institutions are placing massive orders. Please, if you are taking notes, you can underline that word, massive orders. He said institutions and banks and hedge funds are placing massive orders that create real market direction. So you can see that. So it is because of their massive orders that they place during their trading sessions. That is the reason why price actually changes direction. If prices were going up formally and the banks come in strongly with a very big order and say they want to take the price down, which means they want to be seller at that point in time, what that simply means is that they are going to place a very mass sell order, which is going to make prices to fall or literally crash. That's why I said massive orders that can create real market direction. Okay, let's move on. When these big players enter the market, especially during the London and New York session, volatility spikes. So you can see in bracket, it says especially the London and the New York session. So these are the times when the big banks and the corporate institutions, the investors, these are the times that they enter the market to, start entering their trades, start placing their trades. So, and at this point in time, the volatility begins to pick up. This is when trading activity usually becomes at its highest. So let's move on. It says liquidity gets taken and emotional traders get trapped. This is the reason why I said before you enter a trade, you have to be very sure what the market is doing. The flow of the market, money flow. You need to understand what money flow is. But we're still going to come to that. You need to understand what money flow is. Where is the money flowing to? Is the money flowing in an upward direction or is the money flowing in a downward direction? You have to know. Because if you don't know, you're going to be entering blindly and you're going to get trapped, and eventually you're going to have your money taken from you by these big banks. So it's very, very, very important. Liquidity gets taken and emotional traders get trapped. That's why most traders lose, or rather, that's why most retail traders lose. Now, the content didn't say that is why all traders lose. No, he said that is why most traders lose, which means it is possible for you to be a retail trader and still make money, even though these banks are trading. It is very, very, very possible. So this is what this content is trying to tell us. That is why he said why you must know when the big players are trading. It is a very, very, very important topic that everybody must pay attention to. It is very important for you to know when they are trading so that you can trade according with the money flow. And when you trade according with the money flow, you're going to see results and your account is going to get fat over and over again, of course. So now, they enter before or during institutional manipulation. So you can see that the reason why most retail traders lose is because they enter before or during institutional manipulation. Look at it. Which means somebody coming into trade for the first time doesn't even know what he's getting into. He doesn't even know how the market works. He just comes in with his $1,000 account, his $10,000 account, $20,000 account, and he thinks that, oh, he can just buy at any price. No. When you come in, these people don't care whether you are a buyer or you are a seller. What they care about is who is following me. That's what the market cares about. The big players and the banks, they don't care whether you are coming in with a $20,000 account. They don't care. Because these people are trading with billions and billions of dollars. Big time investors, the Elon Musks and the Warren Buffetts, the Bill Gates, they are trading with $500 million. So they don't care about your small retail account. They don't care. If they have decided that they want to take the prices down, the price is going to go down and there's nothing you can do about it. Okay, so that's why most retail traders lose, because they have no knowledge about when to enter the market. And I can bet with you that majority of traders enter when prices are being manipulated. So they always wonder why they are always seeing negative balance. It's because you are always entering at the wrong time. That's why you are always seeing negative balance, because you are always entering at the wrong time. So, but with this our system is going to be telling us when is the best time to enter. And the best time is to enter when these big players are placing their trades and they are moving the price in a certain direction. That is the best time to enter. Okay, so let's move on. I think that's that about that. Let's move on. So how to trade smart now? Identify when institutions are active. You see, very, very, very key. You need to know when they are active. So they have a time of activity and a time of inactivity. So you cannot trade when they are being inactive. No. It's a risk because you don't know when they are going to be active. And when they are active, you can get trapped as a trader and then lose money. So, but as traders, we are looking to trade only when they are active. When they are pushing the price in a certain direction. When they are the one controlling the volatility of the market. This is when we want to start trading. So as it says, identify when institutions are active, usually during session overlaps and high volume time. So you can see that usually during sessions, overlaps and high volume time. So this is another pointer now. High volume indicates that big banks and institutions and corporate bodies have entered the market and they are now placing trades. This is what high volume now indicates. And one of the things our boss scans for is high volume. I'm sure if you attended the last training session, or if you watched the video for the last training session, I talked about this specifically. I talked about momentum. I talked about high volume. I talked about break of structure. If you can't remember, please go back, watch that video again. I talked about all these things. So let's move on. Wait for manipulation to finish. Look at it there. Wait. Because in every market, there must always be a time when they will manipulate, where there will be disagreements, where there will be disputes. Because these are the people that govern this market. These are the people that control this market. So you cannot say because you have a $1,000 account, you want to decide where price. No. They are the one that decides. So allow them, let them decide, and then we follow them with their decision. That's what we are meant to do as traders. So wait for manipulation to finish, let the liquidity sweep and fake breakouts happen. Enter only after confirmation. Like I've said before, you get a strong confirm change in direction signal from the bot. Don't enter yet. Confirm and make sure that, okay, truly this price is moving, and then you enter in that direction. So that's that about that. So I think this is the last point. Say trading is not gambling. Of course, I hear so many people DMing me telling me, "Oh God, this thing is gambling." Yeah, this thing is not gambling. I am a 12-year active trader. I have been trading for 12 years, and I can tell you that with the invention of this our system, this is the best time to be a trader. I remember when I started trading, we didn't have all these automated systems. That was more than 5 years ago. We didn't have all these automated systems. So I had to spend hours behind my chart, 5 hours, 6 hours, even sometimes up to 12 hours behind my chart, looking for a perfect setup to enter. And it was very, very stressful. People thought I was crazy. People thought that I didn't have work. But with the invention of this system, I can just wait for the bot to signal me, give me the best time to enter, and I go to my chart and place my trade. So it now turns out that I'm only looking at the charts for like maybe 10 minutes or 20 minutes per day. That's what it is. So as you can see, trading is not gambling. Gambling is guessing. Guessing means, oh, I think the market is going to go down. You are gambling. As traders, we don't think. We know, because we know based on the evidence that we have seen on the chart. So we know that this price is going down, and then we follow them as they continue pushing the price down. So gambling is guessing. Trading is calculated risk. So you can see that trading is calculated risk. We have done our calculations. We have created this system. The system only notifies us when the price is moving with high volume in a certain direction. That is calculation. So trading is a calculated risk and it's not gambling. So for those of you out there who are saying, yeah, trading is gambling, yeah, I'm sorry, but we're going to have to bust your bubble, because trading is not gambling. Trading is real. There is a lot of money to be traded. This market, every day, there are trillions of dollars being traded every day on this market. So this is not a small market. So please, this is reality. This is not cartoon. This is not game. This is reality. So smart traders don't depend on luck. Again, luck is for novices, people who don't know what they are doing. They depend on luck. But if you are a real trader, you know that there's no such thing as luck in trading. It is either you calculated your trade properly or you miscalculated. That is just the basis of trading. So they use structure, you see, timing, you see, and confirmation to align with institutional flow. I'll take it again. They use structure, 1, timing, 2, and confirmation to align with institutional flow. So you can see break of structure at the right time, and then confirmation of alignment with the institutional flow. That's what makes out a very, very, very good trade. So the Danuvian crypto bot is built on that logic. It helps you read the footprints of big money, so you trade with the smart money, not against it. As you can see, well, that is self-explanatory. I don't need to explain much about that. So let's go to the next topic for today. The next topic is going to be market cap and liquidity. So let's go. Let's look for market cap and, okay, there we are. Market cap and liquidity. This is our second topic for today. So it says market capitalization, or in short form, market cap. Now, let's look at the definition. What does market cap really mean now? Let's look at the definition. Now, market cap refers to the total value of cryptocurrencies circulating supply. Now, let me explain this. It says the total value of cryptocurrencies circulating supply. So a cryptocurrency like, let's say, Bitcoin, Solana, Ethereum. Now the market cap of Bitcoin is determined by the total circulating supply. So if we have like 500 million coins of Bitcoin, at the current price of $100,000. If you do 100,000 times 100 million, that's the total market cap. Market cap simply means the overall money that has been invested. The overall money that has been invested in Bitcoin over the year, that is called the market cap. Now look at it. It's calculated by multiplying the current price of the cryptocurrency by the total number of coins or tokens in circulation, like I just said. So if you are looking to calculate a coin, maybe a friend introduced the coin to you, and you're not so sure about the prospects of this coin, simply ask for the price of the coin. Let's say the price of the coin is at maybe 50 cents per coin, and you ask them what's the total circulating supply. They can tell you maybe it's maybe 5 billion coins. So when you do 5 billion times 50 cents, that will give you the overall money that has been invested in that coin. So you want to be sure that, okay, we have a lot of people who have invested in this coin, so I can also buy this coin as well. That is why our bot, we don't recommend shit coins. There are coins out there that you see that their market cap is $100,000. Yeah, why would anybody invest in a coin like that? You can see that nobody is really buying that coin. If the overall investment in that coin is just $100,000, then that's just too poor. It simply means that there's something shady about that company. So it's not advisable to invest in a coin that has a very low market cap. You want their market cap to be in billions or in the hundreds of millions for you to really invest in that coin. And if it's a coin that has prospects, please the advice here is to wait for their market cap to grow over the time or over the years. Wait for their market cap to grow, and then when it gets to the level which you are satisfied with, then you cannot invest in that coin. So basically that's just what market cap is, and you can say it's calculated by multiplying the current price of the cryptocurrency by the total number of coins or tokens circulation, like I've said. So the formula is market cap equals to current price times circulating supply. That's just what market cap is. Indication: market cap gives an idea of cryptocurrency's relative size and market presence. The reason why Bitcoin is the biggest cryptocurrency in the world is because of their market cap. Bitcoin has the largest market cap out of all the cryptocurrencies in the world. That's why Bitcoin is number one. So let's go to the next point, which is called liquidity. So liquidity. Now we are going to look at liquidity, what it means, and how it actually affects a coin's authentic nature. So let's look at the definition now. Liquidity refers to how easily a cryptocurrency can be bought or sold without significantly affecting its price. So you can see that. How easily a cryptocurrency can be bought or sold without significantly affecting its price. So let me just give a small explanation here. The traditional banking sector, we have the Zenith Bank, we have GT Bank, we have FCMB, First Bank. So all these banks, they have customers that put money in their accounts. So now their market cap is all the customers they have on that bank. They calculate all the money they have in their accounts. Let's say like FCMB now. FCMB has like maybe 500 billion naira. Let's just say 500 billion, which means 500 billion naira, meaning everybody who has an FCMB account, all the money in their account is worth 500 billion naira. That money is called their market cap. That's the overall money that they are controlling. Now, liquidity, on the other hand, now is the amount of money that is available if a user wants to withdraw from his account. That's what is called liquidity. Now, banks are a business, okay? And as banks are a business, the banks will use your money, knowingly or unknowingly. They will use your money to do some business, to also make money, to bring in more profit, and for their investors and their shareholders. So now let's take for example now the market cap is 500 billion. We are using FCMB as an example now. 500 billion, and we all know that banks, they do trade cryptocurrency and they trade forex. So now what the bank will do is bank will say, okay, out of 500 billion now, let's allocate 100 billion for trading of cryptocurrencies and forex market so we can make profit. Now that 100 billion is the bank's investment to bring returns over time. Now the remaining money that is going to be kept is going to be kept in a liquidity pool, and that liquidity pool is called withdrawal liquidity pool. I'll take it again. Withdrawal liquidity pool. The remaining 400 billion is going to be kept in withdrawal liquidity pool, and this pool is for anybody who wants to withdraw their money at any time, because a bank is obligated that when a user asks for their money, they are obligated to pay that user on demand. That is the policy of the bank. So what the bank will do is, the bank already knows that everybody who has account and money in their account with their bank, they already know that these people cannot withdraw their money at the same time. They already know that. So what they will do is they will just allocate a specific amount of money for withdrawal liquidity. So anybody who places a withdrawal on their banking app and so on, ATM, the money is being taken from that liquidity pool and it is paid to the user. So they are fulfilling their obligation. So it's the same thing with cryptocurrency. Let's just say a currency like Solana now. A lot of people have Solana, and Solana's market cap is, I think, $112 billion. Now Solana can say they want to allocate 50 billion for withdrawals. Yeah, because they know that it's not all their investors that are going to sell all their coins and change to USDT. So they will allocate 50 billion USDT for withdrawal. So anybody who wants to make a withdrawal, which means they want to change from Solana to USDT, that's what is called liquidity. So liquidity here just states how easy it is to buy or sell. Or let me just read the definition again. Liquidity refers to how easy a crypto